Are rates really going to get higher? Well, not like you think. I wanted to share this quick video on a possible rate hike due to the G fee, which is a guaranteed fee. Basically, Fannie Mae and Freddie Mac are charging an extra fee to lenders for all loans that they purchase. As we are aware, this includes most of all the home loans that originated in today's market. Most lenders have already raised their rates to compensate for this fee. If not, they most likely will by probably mid-September. Check this out.
FHFA has announced yet another G fee hike on loans being guaranteed through Fannie Mae and Freddie Mac. This is going to take place, guys, on November 1st and is going to be an average hike of 10 basis points.
Okay, now the reason for the change, according to FHFA Director Eddie DeMarco, is to make Fannie and Freddie pricing closer to the level one might expect to see if mortgage credit risk was borne solely by private capital.
So what he's saying is, if we weren't here, people would charge more, so we're going to charge more. In other words, they're raising the G fee rate because it's more reflective of a market that FHFA believes could bear higher costs. And really, make no bones about this, guys, higher fees, though paid by our lenders, will be realized in the form of higher rates by the consumer. FHFA is basically saying your buyers can afford to pay more.
The thinking is this is going to raise more capital for the GSEs, which could help them mitigate any losses they take on their book of guaranteed loans.
You're right. Now, we understand the need for healthy GSEs,
sure,
Fannie Mae and Freddie Mac. But this latest G fee hike is a tad peculiar because it comes at a time when both Fannie and Freddie have gone back to profitability.
Which is strange, because if FHFA is concerned about guarding against losses and Fannie and Freddie are profitable, you'd think passing along higher rates to consumers might seem sort of counterproductive, right?
It does, Frank, and it becomes further exacerbating because if we're truly collectively concerned about a healthy Fannie and Freddie, and we are, and raising more money helps their position, then why has the Treasury changed their policy of collecting a 10% quarterly dividend to taking all the profits from Fannie and Freddie quarterly? All of the profits.
The Treasury's taking all the profits, and the GSEs, well, they're raising the G fee to your clients, which means more money for the Treasury and higher rates for your client. And it's happening November 1st, so let your people know, act now before things go up.
Now, so you understand, so everybody understands, your G fee price is a post-closing cost that our banks are going to absorb, but because they know it's coming, they can anticipate that and add that under your rate sheets. That's why it's going to be more expensive for your clients.
Yeah.
Now, I don't know if you recall this, but just recently, Congress was trying to push for a higher G fee with Fannie and Freddie to cover any BP oil disaster, Gulf disaster costs. So what they were looking at is having everybody who's buying a house finance the cost of the BP oil spill. That's completely insane. And by the way, this is the third recent G fee hike. So the cost of loans is simply getting more expensive.
Yeah, need some extra money. It's that G fee, man. Let's go to that G fee thing. That sounds good.
Well, I hope you all found that video very informative. Again, share this video with a family, friend, or colleague. Subscribe on your left. And again, for Summit Lending, my name is Eric Gausepohl. Have a great week.